free CPD course for UK accountants, where we are looking at financial reporting and the implications of COVID-19. So we've been running this free series for the month of May, and we continue now into June, and we're focusing on issues that are practically relevant right now. Obviously, COVID-19 has created a significant overhang in terms of what are the key issues. And today we've decided to look at financial reporting. I'm joined today by Mike O'Halloran, and Mike will give himself an introduction. But Mike has worked in a combination of smaller firms, larger firms, before moving on to become a quality control reviewer for one of the Irish institutes. And Mike is now actually a member of the OmniPro team. So I know that Mike's material here today, it is excellent, it's on the point, it's practical, it's what do accountants need to consider right now. So wherever you're joining us, whether it be within our Facebook group, the Profit Pro Accountants for Growth Facebook group, and whether you're joining us here live on LinkedIn or you're joining us on YouTube, and wherever you're joining, and maybe you're here on the actual webinar with us, you're pre-registered, please do ask questions. If there is something that is of relevant to you, please do ask questions, and in the comments or in the chat box below, ask the questions, and Jonathan is going to feed them in here to Mike and myself so we can tailor this session to meet your needs. Now, we do have some material for you to download today. So wherever you're watching this, Jonathan will have put a link in the comments below on the Zoom webinar to go into the chat box. And in the comments below, you will get a link to download today's material. Today's material, 3 key elements. The first element is our slides, and our slide deck represents a good summary of the issues, the key points that you need to consider. But we've also accompanied that with our COVID-19 disclosures checklist and a sample UK set of financial statements dealing with this COVID disclosures. Now that sample set of financial statements is also updated for the triennial review, which is effective for your 31st of December 2019 year ends. So make sure wherever you're watching to go to that hyperlink, download those documents. They're an extremely valuable companion set to what Mike and myself are going to cover during this session. In terms of the materials, your questions and answers, I've covered off on that. From a timing perspective here, this seminar is going to run from 2 o'clock until 3. Introduction, 5 minutes, we're nearly finished that. We're going to go into a 40-minute teaching space. Now, Mike has a number of topics that he wants to cover today. He's going to look at, obviously, one of the big ones is post-balance sheet events. So we're here now. This session has been recorded live in the first week of June, and we have 31st of December 19 year ends. We may have January, February, March year ends. But when does COVID-19 become a post-balance sheet adjusting event versus a disclosure event? Obviously, COVID-19 is going to have a significant impact on impairment of assets and knock-on consequences in relation to going concern. And we're going to look here at the director's report and the strategic report and talk a little bit about judgments and key sources of estimation uncertainty, given that there is so much estimation uncertainty, and there are going to be so many key judgments made by directors in preparing their financial statements. So, Mike, maybe I'll hand over to you, and if you could just give a brief introduction, Mike, to yourself, your background, and why should people listen to you here today on this session?
Thanks very much there for the introduction, Des. I suppose, look, by way of background, I'm a recent addition to the practice support team in OmniPro. My day-to-day job in OmniPro, pre-COVID, was going out to firms, reviewing files, carrying out hot file reviews, cold file reviews, etc. Prior to joining OmniPro, I spent a couple of years with Chartered Accountants Ireland, the main regulatory body in Ireland for accountants. And my role there was going out to firms, inspecting their audit work, inspecting their AML, financial reporting, etc., as part of the 6-year monitoring process. And prior to that, I would have spent 12 years in practice, kind of 6 years in quite a small practice, dealing with, I suppose, a bit of everything. You might say a bit of tax, a bit of audit, a bit of COSEC, a bit of accounts preparation, and then another 6 years in a predominantly audit-focused role. So I suppose that's my background as to how
The thing I like about your background, Mike, is I like about your background that you've obviously worked at a regulatory level where you've dealt with big firms, small firms, medium-sized firms. So you've come from the other side of the fence in terms of understanding what the institutes want and need to see. But you've also come and ascended from a small firm background through to a larger firm on your journey. And I think what that gives, Mike, is that gives very, very practical insights and interpretation. And because that's what people really want. They want answers. They want, yeah, we need to understand the theory, but how do I solve the problem? And I think that's one of your strengths, Mike. So, Mike, in terms of the topics that you want to cover, and in terms of the topics that you're going to cover today, I've given a preamble on the topics. Do you want to jump straight in, Mike, into, well, actually, maybe talk about your downloads first and the value in your downloads, and then maybe just to jump straight into post-balance sheet events.
Yeah, I think I'll just start there by just sharing my screen here. So hopefully that appears in a matter of seconds. Yeah, so just to go through the downloads, we've 3 downloads today. Obviously, as you mentioned in the slides, which we have in front of us here, we also have a set of financial statements just with some illustrative COVID-19 disclosures. We've gone with a medium to large set of accounts, and depending on the size or nature of the company, that can be scaled down as appropriate. So it will cover the disclosure requirements of a medium to large company. And we also have a COVID checklist. Let me just bring that up on the screen. It's quite a handy one. It's quite a short document, but it's a good one if you have maybe a set of financial statements on the shelf for the last couple of months. You're revisiting it now, just looking at the adequacy of the COVID-19 disclosures. So I mean, that's quite a useful, short, succinct document. So make sure and download the documents and have them, because they'll come in beneficial. Just as regards the topics today, so as you mentioned, Des, we're going to be covering post-balance sheet events, which is one of the key topics, one of the key financial reporting areas impacted by COVID-19, impairment of assets, going concern, director's report and strategic report, and then judgments and key sources of estimation uncertainty. So I'm kind of conscious of the time, so I'll get stuck into the first topic.
Yeah, one thing to clarify, Mike, you've already said it, but just to remind everybody, this is being done under FRS 102. So it's been done under FRS 102 and UK company law. So it is full FRS 102. Obviously, there are derivations and derogations for Section 1A of FRS 102 and a different framework for people using FRS 105. Let's get into post-balance sheet events here, Mike.
Yeah, and as I said, it's kind of one of the key issues that's come across our desks in the last couple of months. I suppose when we study accountancy and we do our exams and do all of those kind of things, there's loads of textbook examples of post-balance sheet events, and it's typically the debtor that's gone out of business, or the fire in the factory and things like that. COVID-19 has presented a totally new example, which is the outbreak of a global pandemic, and when does that become an adjusting or a non-adjusting event? And I suppose it's not that clear cut initially when it becomes an adjusting event or a non-adjusting event. So we have to look to Section 32 of FRS 102, along with the guidance from the regulators, to arrive at our conclusion there. So obviously the key issue under Section 32 of FRS 102 is whether it's an adjusting or a non-adjusting event. We'll see some FRC guidance shortly as regards December 19 year ends, and it seems to be pretty clear cut that in the vast majority of instances there will be it'll be a non-adjusting event for a 31 December 19 year end. But then as the months go on, January, February, March 2020, it becomes less clear cut, and there's maybe a little bit more judgment involved in arriving at the conclusion as to whether it's adjusting or non-adjusting. There's also within the post-balance sheet events section of FRS 102, there's a bit of interaction with Section 27, which is impairment, which we're also going to cover today. And we have to carry out an impairment review when there's impairment indicators. One of the impairment indicators is adverse economic effects after the year end. So by virtue of COVID-19, there's going to be an impairment indicator. And by virtue of there being an impairment indicator, we then have to consider whether this an adjusting event or is it a non-adjusting event? And there's also a bit of interaction with going concern in post-balance sheet events, in the sense that if management decide after the year end that they're going to liquidate the business or permanently cease trading, well, then we have to prepare the accounts on a breakup basis.
Yeah, Mike, I think based on our one-to-one interaction with accountants in your consulting role and in your advisory role, you've laid out one of the big confusions on this very first slide when people are fresh. Section 32 of FRS 102 is the precursor, because there's a lot of confusion around impairment. I have impairment indicators. Do I need to do impairment reviews? It's yes, Section 27 is its own section. Interaction with going concern, that is its own topic, its own section. But Section 32 of FRS 102 is the deciding standard, no matter what. Is this an adjusting event or is this a non-adjusting event? We may have impairment under Section 27, but we still have to go through the Section 32 filter. Yeah,
and I suppose this is just an extract from FRS 102. I'm not going to repeat it, but it just highlights the fact that, well, there are events that indicate circumstances that existed before the year end, or circumstances that are conditions that arose after the year end. Again, there's no point in repeating that, just to highlight where it's defined within FRS 102. This slide is quite a good one in kind of trying to arrive at a decision as to whether something is adjusting or non-adjusting. And I suppose if we look at how the virus has progressed over the past, whatever it is, 6 months now, it doesn't feel like 6 months, but over the past 6 months, on the 7th of December 2019, we had the first case confirmed in Wuhan in China. On the 31st of December 19, it was identified as a new strain of coronavirus. The World Health Organization notified. 24th of January 2020, the first European case reported. Considering what we're discussing now, this date is going to carry quite a bit of significance. The 31st of January 2020, when the first UK case was confirmed. Then throughout the month of January, there were several new cases in China, 10,000 by the end of the month. In February, several new cases in Europe. From a Republic of Ireland perspective, the first case appeared in the Republic of Ireland on the 29th of February.
Yeah, but look at the 23 cases reported in the UK by the month end in February, Mike. Like in the UK, really, February year ends. There's limited debate. It was there. It was happening. And where's your judgment coming down, Mike, on one case in the UK by 31st of January 2020? Is that enough to describe coronavirus and all of the financial reporting impacts as an adjusting event, or what's your thoughts?
I suppose it's down to perception, really. The issue that the likes of the FRC seem to be going down the route of is, that it wasn't just the presence of one strain of the virus in China that was the issue. It was the significant human-to-human transmission. I suppose once it made its way into the UK, there's probably an argument at that point that it could be an adjusting event at that stage. But I don't think anyone really could say you're absolutely wrong or you're absolutely right. And it really is down to perception. But I mean, you also have to remember that the post-balance sheet event isn't necessarily going to be coronavirus. It's going to be a debtor going out of business. It's going to be a property that's been impaired. So you have to kind of look beyond the dates to a certain extent, that, if you have a debtor, for example, in Ireland, and if you have a debtor in Italy, well, the date that it became an adjusting event is probably a bit earlier in Italy or in the UK than it possibly was for the Republic of Ireland, just because the first case was reported earlier in those two countries. So it does take a bit of judgment, but I mean, I don't think you'd be wrong in saying that 31st of January 2020 could be the cutoff point, but it is subject to judgment, and
Okay, so obviously we have to look at it on a case-by-case basis, and Mike, I can't push you to make a definitive statement on this because you can't. Folks, it is down to professional judgment. But I suppose me looking at this, 28th of February year ends onwards, coronavirus is an adjusting event for the most part. 31st of December 19 year ends, following the position of the FRC, it's probably not an adjusting event.
Yeah, so the line just dropped before that last comment is?
Yeah, so the FRC, so for 31st of December 19 year ends, it's probably not an adjusting event following the FRC guidance.
Absolutely, yeah.
Disclosure, but not adjusting.
Exactly, yeah. And just to kind of tie that into the FRC guidance, I'm not going to read the entirety of this slide, but if we read the second paragraph, and this, bear in mind, this is coming from the FRC, a release by the FRC in March of 2020, and it's in the context of IAS 10, but I mean, we can take it for it to be in the context of FRS 102 also, because there's the two are consistent. So there's a general consensus that the outbreak of COVID-19 in 2020 was a non-adjusting event for the vast majority of UK companies preparing financial statements for the period ended 31 December 19. Companies will need to judge how much the impact of COVID-19 should be considered to arise from non-adjusting events from subsequent reporting dates. This will be highly dependent on the reporting date, the specific circumstances of the company's operations, and the particular events under consideration. So I mean, that's just highlighting the fact that you might have multiple factors at play. It's not necessarily just one. It's not just dependent on one particular date. So again, this is just a kind of a very rough case study here. So X Limited prepares financial statements to 31 December 19. X Limited has customers in the hospitality sector, including customer A, who owns a hotel. So in March 2020, customer A permanently goes out of business as a result of the restrictions placed on it from COVID-19, and the debt of £10,000 will not be recovered. So the first question is, does an adjusting event occur in the financial statements of X Limited for the December 19 year end? I think based on the FRC guidance, we're pretty clear cut there that the answer to that question is no. Sorry, my handwriting is terrible. But it would be a non-adjusting event, and we would be required to disclose that accordingly within our financial statements. So then if we apply the same circumstances to a January, February and March 2020 year end, well, then it becomes a bit less clear cut and a bit more open to judgment. So January 2020, bit of a question mark over that as to whether we decide whether a January 2020 year end, is that an adjusting date or not, a non-adjusting date. February 2020 and March 2020, I think based on our discussions there, we're quite satisfied that that is an adjusting event because the events or conditions were present in February 2020 by virtue of there being, I think it was 23 cases on the 29th of February. And March, I think it's very hard to argue your way out of a March 2020 year end. That's
yeah. So February is adjusting, March absolutely adjusting. Question mark over January, but our gut feeling is not adjusting, and 31st December 19, well, the FRC have made it quite clear.
Yeah, exactly, yeah. And I suppose the final question I'd ask there is, what if the customer went out of business in January 2020, so before there was any coronavirus? What are the December year-end implications? Well, in that situation, we go back to our normal post-balance sheet event circumstance, whereby a debtor that goes out of business after the year-end, that's usually indicative of circumstances that were at play during the financial year end. So in that situation, that would likely be an adjusting event. And it would likely be that that wasn't a COVID-19 implication at all, that it was just, your normal economic circumstances. So the final couple of points on post-balance sheet events. The first point is more probably from my time as a reviewer. This might be more of an audit point than a financial reporting point, but it's still relevant. Documentation of the post-balance sheet events to support your disclosures is key, because there will be a significant level of judgment involved. Given the changeable nature of the pandemic, it's more important now than ever to consider post-balance sheet events right up to the date of sign-off. I mean, okay, things might start to calm down, but for a time, things were changing on a day-by-day basis, so you kind of had to consider things right up to the date of sign-off. 2019 year ends likely not to be adjusting. 2020 year ends, there'll be a higher degree of judgment.
Yeah, but the whole documentation procedure here, Mike, if it is an audit, and I know today is about financial reporting, but even financial reporting and compilation engagements around directors' judgments, ISRIS 4410, not required to document at all like an audit. I'm not suggesting that, but at least to have some sort of clarification. But from an audit perspective, Mike, there's no options here. This is going to be one of the big issues. Not just have you got the disclosures right, but how have you documented this from an audit perspective?
Oh yeah, absolutely. And I'd imagine when the reviewers are now all back on the road again, but I'd imagine that'll be a big area of focus. You know, it's as Colin would say, it's kind of low-hanging fruit for a reviewer, that if you're not documenting things like that and not supporting your judgment on the file, it's an easy win for a reviewer. So I mean, here are some of the areas that might be potential post-balance sheet events, adjusting items. So stock. So for example, where we have a business that was potentially closed temporarily overnight or mothballed or whatever the case may be, you could have potential net realizable value issues as a result of the closure. A debtor that's gone out of business, that's your standard one that we would have discussed a few slides back. Property impairment, and again, you know, certainly in Ireland, we haven't had sight really of how badly properties have been impaired, because at the moment we don't really have an active market, but one can only assume that there will be some sort of a negative impact on property. Changes in accounting estimates, you know, changes in fair value. They're the type of areas that will be impacted by post-balance sheet events. So just to close it off then, if it's a non-adjusting event, we're not required to have an adjustment. However, the nature of the event should be disclosed, and an estimate of its financial effect or a statement that such an estimate cannot be made. And I suppose I think it was the ACCA or one of the regulatory bodies had a bit of commentary there recently, and you know, an estimate of the financial effect is far superior to a statement that such an estimate cannot be made. So, and even if you can provide a range of potential estimates, it's better than a statement that no such estimate can be made, because I expect that might be a hot topic, and as things move forward a bit, that instead of including a statement that an estimate cannot be made, that it's preferable for the regulatory bodies to have a range of estimates.
And Mike, just one thing from a disclosure of significant judgments and estimation uncertainty, I know we're going to come to this later, and that's obviously a requirement for FRS 102, but even if it's not a compulsory requirement for Section 1A of FRS 102, that should not negate the requirement to comment on it if the truth and fairness of the financial statements is affected by some sort of a significant uncertainty, or something as a range of estimates. Even in non-full FRS 102, Section 1A FRS 102 accounts, that needs to be detailed and disclosed or acknowledged in the disclosures.
Yeah, absolutely. I mean, even if it's not explicitly stated that you need to include it, if it is required to show a true and fair view, that overrides any disclosure requirements under Section 1A. For adjusting events, I mean, it's quite obvious an adjustment is required, and then include the related disclosures to reflect the adjustments. So that's straightforward enough, I suppose.
Just before we go on to topic 2 there, Mike, I see there's just a couple of questions in here from various sources. There's just some questions about downloading the material. Jonathan puts up the link in the chat box if you're live with us here on the Zoom call. If you're live on the Zoom call, Jonathan has put the link up in the chat box, and you can download right now and download the material and go through it with us as we are doing it. That's the intended way to do it. You can possibly, that link may work until this evening, but when we finish each webinar, we take down the links. So I would strongly suggest that if you want the material, you download it now. We cannot guarantee that it will be available. And obviously, as you understand, folks, this is a free event, and we're not in a position to email people afterwards. In terms of this being a free event, yes, absolutely, you can attend these free. There is no cost. Invite your colleagues, invite your co-workers, and invite your peers. Jonathan, maybe you could put up a link in the chat box and on the various social media platforms, so that people can register to get onto our free COVID webinar series. So Jonathan is going to put that up into the chat box now, and he'll put up a link, and you can share that with colleagues, friends, and get them to register. Mike, topic 2 is impairment. And obviously, we are facing into what is being described as a panpression, and we hope that things are not as severe as it is being indicated that it could be, but assets are impaired, and Section 27 of FRS 102 is back in the front line again, like it was back in 2008, the last recession.
Yeah, and I suppose Section 27 has kind of, I won't say has been dormant, but it certainly hasn't been to the forefront in the last, I don't know, 5-6+ years, purely because, you know, we carry out an impairment review when we have indicators of impairment. And, you know, I mean, not saying things have been perfect, but things have been moving along quite nicely over the last few years. So a lot of the time, the conclusion was that, you know, there were no indicators of impairment. You know, however, now COVID-19 is here. It's hard to deny that there is certainly at least one indicator of impairment as set out in Section 27.9 of FRS 102. And the one that's certainly there that we can't argue against is that there's been significant changes with an adverse effect on the entity that have taken place during the period or will take place in the near future in the technological, market, economic or legal environment in which the company operates or in the market to which an asset is dedicated. So, you know, I don't, well, unless you're a company that's totally insulated from the effects of COVID-19, the majority of companies will have some kind of an impairment indicator as a result of COVID-19. Another one that's there that companies could be caught by is evidence is available of obsolescence or physical damage of an asset. So, you know, what you might have there is, you know, a shop or a pub or something that was closed overnight, there's stock in there. You're not going to recover the net realizable value of that stock, so there's an evidence of impairment as a result. What type of assets can typically show signs of impairment? I mean, you could kind of go on, but here's a few: debtors, stock, property, goodwill, investments in subsidiaries, group loans, etc. So basically any or most assets on the balance sheet can have some signs of impairment. So what disclosures are required in relation to impairment? We're required to disclose the amount of the impairment loss recognised or reversed in the period and the circumstances leading to it, and we recognise the impairment in the profit and loss unless it relates to a revalued asset. So I mean, if the asset that we're now impairing was previously revalued upwards, the first place we put our adjustment to is the revaluation reserve, and if there's a balance left over, then we put that to the profit and loss account. When we're looking at the impairment, there's a good slide coming up, but just to go through some of the text here. So what do we look at when we calculate impairment? We take the higher of fair value less cost to sell and value in use, and we call that the recoverable amount. The recoverable amount is the sale of an asset on an arm's length transaction between knowledgeable and willing parties. So I mean, that's basically, you know, if I owned a house, how much would that house sell for if I was selling it on an arm's length basis between a willing buyer and a willing seller? Value in use, then, I suppose we could do a whole hour on value in use in itself, but value in use is the future discounted cash flows derived from an asset or cash generating unit. So that's where we take, you know, budgets for an asset or a group of assets. We project them out over a period of time, or as long as we can project them out for. We look at the present value of the cash inflows and the outflows, and that is what we arrive at for our value in use. There's a lot of rules behind that. And as I said, we could probably cover an hour in itself just talking about value in use. But when you are using that, just make sure and follow the rules within Section 27 of FRS 102. So when we take these two amounts, we take the higher of those two amounts, and we call that our recoverable amount. We compare that to the carrying amount. The carrying amount is simply the value that's held on the balance sheet. If your recoverable amount is less than your carrying amount, then you impair.
Mike, just a really quick question before you go on. In relation to the impairment, so you talked about recognizing the impairment in the profit and loss account, and obviously you reverse, if there was a previous gain recognized, you reverse that out. When you're doing the impairment through the profit and loss account, Mike, do you feel is that the disclosure of that item in the financial statements, do you feel is that to be treated as an exceptional item and brought out onto the face of the P&L account with supporting note disclosures, or the physical accounting treatment for that?
Yeah, I mean, if it's of such significance, absolutely, yeah. I mean, I would be of the opinion that you have an exceptional item there. I mean, it's exceptional circumstances, you know, and I can't remember the exact text within FRS 102, but if it's of such significance that it requires to be itemized separately, then yeah, that should be shown on the face of the P&L as an exceptional item. So this graph is quite a useful one just to show the decision-making process when we look at impairment indicators. And I suppose typically, maybe for the last couple of years, the route that we would have taken was kind of, we always start in this box here. So are there indicators of impairment present? We look towards section 27.9A of FRS 102. Quite often in the past couple of years, the answer to that was no, and as a result, there's no further work required. You know, I know as a reviewer, it would have been a kind of particular bugbear of mine that, you know, you go to a fixed asset section, there's a big, you know, there's working papers there, and the question is, are there indicators present? And the answer is no. You know, it was a particular bugbear of mine that, you know, well, you haven't explained why there's no indicators present. But anyway,
that's not going to be an issue in the current year, Mike, because
no,
there will unquestionably be indicators of impairment.
Absolutely, yeah. So now that there's indicators present, we kind of have to go down the route here. So we look at our carrying value, and again, that's pretty straightforward. That's the amount that we're looking at. You know, our stock, our property, plants, and equipment, whatever we're looking at. We compare our carrying value with our recoverable amount. When we're looking at our recoverable amount, we're taking the higher of fair value less cost to sell and value in use. And then we're taking the higher value, obviously. We then compare recoverable amount to our carrying value. If the carrying value exceeds the recoverable amount, then we have an impairment loss, and we charge that to the profit and loss account, obviously subject to the, if it was revalued in the past, we hit the revaluation reserve first. If the carrying value is less than the recoverable amount, there's no impairment identified and there's no adjustment required. Another thing that's worth noting here is that if we're looking at the recoverable amount and we calculate, you know, our fair value less cost to sell, and that already exceeds the carrying value, well, then we don't need to look at value in use. You know, if one of them is high enough for there to be no impairments, well, then we don't need to calculate the other one. So that's worth stating. But if you do have impairments, that's a very useful graph to kind of go back and look at, because it kind of sets out the decision-making process quite well as regards, you know, what should we do if we have impairment indicators and how should we address that. So fair value less cost to sell. So that's basically a sale at arm's length, less cost to sell. It must be between knowledgeable, willing parties, and it must be in an active market. And I suppose that's a little bit of an issue at the moment. Do we have an active market? Are there actually property transactions occurring at this period of time? I know I was talking to an estate agent last week, and he basically said everything had slowed down. The visibility that he was having was that, you know, property prices were going to go down, but he just hadn't any indication by how much. So you might have a situation in this short window of time where, you know, things are kind of starting to show signs of getting back to normal, but we're not kind of in an active market phase. You might have a situation whereby for a period of time there's no active market. And if that's the case, well, when we're looking at a recoverable amount, we might have to look at a value in use, because the fair value less cost to sell, it might be possible to see what that value is at the moment during the period of time when there's no transaction happening.
And Mike, just obviously the Institute of Engineers, the Valuers Institutes have now come out and said their members are providing valuations. That implies that, well, there is fair values, but the market would demonstrate something slightly differently. So I suppose this is, and we try not to deal, folks, in judgments and what ifs. And, you know, if you want to go read the standard yourself, you can go read the standard. We try and put our interpretation on it. But Mike, like, fair value right now, obviously, if there's an independent valuation or an independent report that can be relied upon, that's done under the right parameters, well, then that means there's a fair value. The real issue arises here is where owners of assets are either not prepared to go get those independent reports, or when they do go to get the independent reports, that actually the independent reports are heavily caveated to the point that they're almost valueless.
Yeah, and I suppose what you have there is you have a valuation technique which you're allowed to use to determine fair value, provided there's a reasonable amount of parameters there. You know, and what you might find is, going on to, I think, our last topic today is the whole area of judgments. You might find that in itself is a key judgment. The fact that you've got a valuation, the valuation is subject to parameters. You know, it could be as low as this or it could be as high as that, and those parameters are a lot higher than they would be on normal time. So, you know, nothing wrong with getting that, but you might want to quantify. You know, in your key judgments note, you know, this is one of the key judgments. And it is an area of uncertainty. Moving on to value in use. So again, we spoke about that. It's the present value of the future cash flows expected to be derived from an asset, and it involves the following steps. So estimating the future cash inflows and outflows to be derived from the continuing use of an asset and from its ultimate disposal, and applying appropriate discount rates to those future cash flows. So as I said already, there's quite a few sets of rules within Section 27 of FRS 102. So just make sure that you're following those. We don't have enough time to go through all of those today, but you know, there are certain rules, such as you can't use tax. You can't take credit for future efficiencies that you might be implementing. So if you are using value in use, just make sure and go back to Section 27 to look at what you can and can't do. Topic 3 is going concerns, and again, similar to the other two topics, it's hard to deny going concern will be a huge issue for most companies, and it'll be of varying levels of significance depending on how impacted a company is by COVID-19. There'll be circumstances where the appropriateness of the going concern basis might be called into question. Adequacy of disclosures is going to be huge. And again, that's dependent on how significantly impacted the company is by COVID-19. And FRS 105, I suppose we also have to consider, although today is looking at full FRS 102, that can obviously be tailored down for Section 1A. It's still a matter of concern under FRS 105, to the extent that you still need to look at the going concern basis, the adequacy of that basis, albeit the disclosures are, on the most part, not going to be necessary on the most part. Going concern impacts. So this, I'm not going to quote this back, but this is the section of FRS 102 dealing with going concern. I think it's section 3.8 and 3.9 of FRS 102. And that's just basically commenting on that you make an assessment as to whether the entity will continue as a going concern. And it's a going concern if the usual parameters looking 12 months into the future, or is there only realistic alternative to permanently cease trading? And where there's material uncertainties, we're required to disclose the details of those uncertainties. This might be an overly simplistic way of viewing it, but one thing we've kind of looked at is, consider where your company lies as regards these four headings on the whole spectrum of being impacted by going concern. So the best companies at the moment, not affected by COVID-19 or will perform better as a result of it. So I mean, the types of companies that you'd be looking at there, possibly the likes of pharmacies, food retailers, IT companies that have kind of got a benefit. They've actually benefited from COVID-19 because they've been busier as a result. The next level down, companies that are affected by COVID-19, but the directors are satisfied that no material uncertainty exists. So again, they might be companies that had a temporary slowdown. Things aren't as good as they could be, but there's plenty of headroom there, and they don't think COVID-19 will be a huge impact on the business. The third one down, and I think a lot of companies will fall into this category, affected by COVID-19, and the directors believe that a material uncertainty exists. So, I mean, what you might have there is the likes of your businesses that have been severely impacted. I don't know, the likes of your hotels, pubs, hospitality, any business that's kind of reliant on people kind of congregating, and any business that's maybe dependent on the discretionary spend and things like that. So where you have those types of companies, there will be significant disclosures required in the financial statements. The fourth band of companies down, severely affected by COVID-19, and the directors need to consider if liquidation is the only realistic option. I think we're not for the furlough scheme and the wage subsidy scheme. I think a lot of companies, might have ended up in that category. So I don't think there's been a huge amount of companies so far that have ended up in that category, but it is something that needs to be monitored.
Yeah, we're in suspended animation at the moment a little bit, Mike. Obviously, some sectors have been hit worse than others, but this is already, the clouds are already on the horizon in what you're describing there as category 4. And I'm not sure where JR pulled this question from, but he's after sharing a question with me here on screen, and the question is in relation to audit and non-audit. So obviously today is about financial reporting. We are going to do a full financial reporting workshop. So we're going to do a full 8-hour financial reporting workshop dedicated for the UK, where we go through all this stuff in significantly more detail. And we are also going to do a 1-hour webinar and a complete audit workshop going through from an audit perspective. But today, in the context of financial reporting, obviously, if it is an audit, the auditor has a higher burden in terms of forming an opinion that the financial statements give a true and fair view and have been properly prepared in accordance with the applicable financial reporting framework. Audit exempt is covered under ISRIS 4410. And ISRIS 4410 in relation to compilation engagements, just because you're not forming an audit opinion, does not give a carte blanche. And the compiling accountant must ensure that the financial statements have been prepared in accordance with the applicable financial reporting framework and give a true and fair view. The compiling accountant, if a member of a recognized accountancy body, should not allow their name be associated with financial statements that are false or misleading. So, going concern in coronavirus, it crosses that boundary of traditional going concern under ISA 570 from an audit perspective into financial reporting full. And and directors have responsibilities in terms of preparing accounts from a company law perspective and to make sure they give a true and fair view. So while they may not be monitored or regulated to the same standard or the same level, this is an issue.
Yeah, absolutely. Yeah. So if we look at the 4 companies, so the first band of companies not affected by COVID-19 or will perform better as a result of it. I mean, that's pretty straightforward. Possibly no disclosures required, no immediate issues. You might look at, well, have they any long-term issues? Do they have any property on the balance sheet that might show signs of impairment? But when we looked at those 4 category of companies, the first set of companies, that's quite straightforward. There's no significant issues there. The next band down, so affected by COVID-19, but the directors are satisfied that no material uncertainty exists. So there you might have a company with an initial slowdown, but the directors believe that it's short term and they'll return to normal once the period passes. You may, well, depending on the circumstances, you may require a going concern note just to explain why there's no material uncertainty. So if there's I don't know if you have net current liabilities or if you had a loss in the year or something along those lines, but the overall picture isn't too bad and you're satisfied that there's no material uncertainty, you obviously might need a note there. The more significant ones, so affected by COVID-19 and the directors believe that a material uncertainty exists. So these are companies that maybe have been temporarily shut down. The budget's indicated to be a difficult trading period. Costs are being cut as much as possible to keep the business alive during the period of uncertainty. You believe that the going concern basis is appropriate, but a material uncertainty exists. Well, in that situation, you might need you will need a going concern note and explain the material uncertainty, etc. It's also worth stating too that within the handouts, the example financial statements that we have, I think Jonathan's put the link in at the start of the webinar. Within those example financial statements, we've included some COVID-19 disclosures. So when you're going through those set of financial statements, the section highlighted, or the parts that are highlighted in yellow, if you look at those, that'll give examples of of illustrative disclosures. And I suppose it's worth noting too that those disclosures, they're more of a starting point than it's disclosures that you can copy and paste. That the disclosure should be tailored for the particular circumstances of the company. Then we have the last set of companies within that band, so severely affected by COVID-19, and the directors need to consider if liquidation is the only realistic option. In that situation, well, you need to be looking at, well, are they going to permanently cease trading? Potentially apply the breakup basis if the going concern basis isn't appropriate, disclose the fact in the financial statements, and restate assets to net realizable value. So again, that'll be a consideration for companies where the only realistic alternative is liquidation. So what should a going concern note with material uncertainty include? You'll see that this slide, most of it is highlighted. The reason it's highlighted is that's the requirement that if we are having an audit, that's what's required under ISA 570 to be included in a going concern note. However, if there is a material uncertainty relating to going concern, if we're applying section 1A of FRS 102 or full FRS 102 and we require additional information to give a true and fair view, we should consider including the shaded parts in the note. So what are we required to include? So details of the uncertainty, including a description of the events or conditions that cast doubt on the entity's ability to continue as a going concern, management plans to deal with these events, a clear disclosure that there is material uncertainty which may cast significant doubt on the entity's ability to continue as a going concern, and then a statement that it may be unable to realise its assets and discharge its liabilities in the normal course of business. So again, that's quite a substantial note, particularly if you're audited. I suppose just to briefly cover off on FRS 105, the disclosures from a going concern point of view, they'll be minimal in most instances. One particular situation just to watch out for, and again, this is probably more common in Ireland than it is in the UK, but if you have a company that's prepared under FRS 105, that's audited, and it has a material uncertainty relating to going concern, well then your disclosure note should include what's on the screen there. That it's required to include that as required by ISA 570.
So just a word of warning here, folks, in relation to disclosures. So Mike has given you in the downloads a financial statement disclosure checklist. He's also given you a sample set of financial statements. Now, at the moment, we're watching financial statements that are being submitted. We're watching financial statements from the big four, the top 10, to see practically how they are approaching the issues. There is no, in our mind, there is no such thing as standard wording that you can use for anything in relation to coronavirus. Over time, standard approaches may develop and evolve. But right now, we believe that you need to make sure that the wording is appropriate and tailored to your individual client. And one of the big criticisms of the accountancy profession, and one of the problems that the institutes have from a monitoring perspective, is the use of boilerplate paragraphs and templateized paragraphs. Now, we believe in templates. We believe in making things simple and practical for yourselves. But right now with coronavirus, we have given you a set of financial statements. Mike has referred there to sort of standard wording and to go on notes, but you have to use them in the context in which they are given. And it's thought generation. There is not yet a one-size-fits-all wording for coronavirus issues, be it post-balance sheet events, impairment, going concern, or anything else that Mike is going to cover in today's session.
Yeah, and I think just to follow on from that point, that there's so many movable parts here. You have companies that are, severely impacted, minimally impacted, and everything in between. You have businesses that were closed earlier, businesses that were open, that reopened earlier. So, there's probably too many eventualities that what's in those disclosures is probably more of a starting point than anything else. But just to finish off on FRS 105, measurement and recognition, that'll still be impacted by COVID-19. So we'll still have impairment, we'll still have consideration of post-balance sheet events, albeit the disclosures will be non-existent, and we're still required to assess the appropriateness of the going concern basis. So we're still required to look at a period of 12 months. So I suppose don't assume that if we're applying FRS 105 that COVID-19 has no impact. It does have an impact, albeit that the disclosures in the financial statements will likely not be severely impacted. So topic 4 that we're going to cover is just the whole area of the director's report and strategic report. Again, within the downloads, there are the example paragraphs within that. So we're going to talk about principal risks and uncertainties, future developments, events since the year end, potentially whether you need to include a going concern disclosure within your director's report. And obviously, that should actually say small company versus medium company. There's obviously less of a requirement for small companies for the above items. So contents of a strategic report. I suppose the big thing that we're required to do here is do the description of the principal risks and uncertainties facing the company, and also above that, we're required to include a fair review of the company's business within our strategic report. And obviously, if coronavirus is hit either during the year or after the year end, that should be incorporated into our directors and strategic report. So principal risks and uncertainties. So that's required for medium to large companies. Given the rapid emergence of the virus, the required disclosures will change over time as the pandemic develops across regions. And I think I have an example in one of the next couple of slides about the disclosures that were appearing when it broke versus what's appearing now. And you'll see that things have developed quite a bit over the period of 2 or 3 months from the 2 disclosures. Another thing to consider here is that the risks and uncertainties, they should be specific to the company. So, you've got credit risk, have you got high risk debtors, economic risk, are you in the pub hospitality, that kind of sector where things might quieten down, where there's huge gatherings of people, and are you trading with affected countries? I suppose when coronavirus first hit, it was, the disclosures that we were seeing were more of a kind of a supply chain risk. So, companies that were trading in China, would those companies have access to the supply chain? And then obviously when it made its way into Europe and subsequently worldwide, it was no longer a supply chain risk, and it was more of an economic risk, credit risk, healthcare risk, those kind of things.
Principal risks and uncertainties, obviously specific requirements in company law, specific requirements in full FRS 102. What if I am a small company and I do have principal risks and uncertainties? Do you have any thoughts on going above and beyond the minimum requirement, particularly if we're going to have disclosures in the notes to the financial statements that identify principal risks and uncertainties? Should this stuff drop back into the director's report, or have you developed any thinking on that yet, or seen any examples of that yet?
I suppose as regards to the director's report, I'd be in, if it's not specifically required, I wouldn't be inclined to put it in. You are required to put in your details of important events that have occurred since the year end. So if you feel the need that that the principal risks and uncertainties fit well in there, well, put them in. If they're required to give a true and fair view, well, then they should be going into the notes to the financial statements. If it's not a specific requirement, I'd be inclined to say, well, no, not necessary to put them in there. I have 2 examples of principal risks. The first example that we see in front of us, and again, before you say it, Des, I probably should give the disclaimer. These examples, they're live examples from companies that have publicly submitted their accounts, and they're purely presented here for educational purposes. They're not a positive or negative comment in any way towards the financial statements that have been signed. This is a company called Delata Hotels, which is the largest hotel operator in Ireland. I think they're the largest anyway by a long shot. These financial statements would have been signed towards the middle of February, so before any coronavirus hit Ireland. The sum total of coronavirus or COVID-19 being mentioned in the financial statements is down here. So they've commented that Brexit negotiations and the international response to the outbreak of coronavirus are of near-term concern, and it's something that we'll monitor. So again, and in fairness, that probably reflects certainly where I was as regards COVID-19 at that point. I knew it was there, but I knew it was there. I knew it was a risk, but it hadn't become a huge risk at that period of time. So bear in mind, this is around the 20th of February. And subsequently, I think maybe 2 or 3 weeks later, all the hotels in this group had temporarily closed as a result of the government restrictions following COVID-19. This is BT, the telecommunications. So this, I think these were signed back in May, and you'll see that there's quite a detailed disclosure here. At least one, and this isn't the sum total of all the mentions of COVID-19 in the financial statements. It's mentioned elsewhere, but this is the main risk that they've identified as a result of COVID-19. So they're talking about the continued suspension of sport. They're talking about bad debts, customers, corporate customers, etc. Cash positions. They're talking about potential pension deficits, and then they're talking about how they're going to manage it and how they're going to focus on that for the coming years. So you'll see in the space of, I think it was maybe 2 or 3 months between the two sets of accounts, that it became something that barely got a mention in a set of financial statements to something that was nearly at the forefront of the disclosures in the financial statements. So future developments, and again, this is kind of one that kind of gets the generic treatment under normal terms, the future developments disclosure in the director's report. So we're required to include an indication of any likely future developments in the business. So obviously, if we have a year end of December, COVID-19 is hit, we should be commenting on that within our future developments paragraph. So I mean, even if we have the best intentions in the world for the company, we can't ignore the fact that the short-term concern for the company is coronavirus and how we're going to address that. That's an illustrative disclosure that's within the financial statements that we have in the downloads pack. So I'm not going to read it back because I think we're coming close to 3 o'clock. Events since the balance sheet date. So again, this is required by all companies. So the director's report should incorporate a summary of the important events affecting the company which have occurred since the end of the financial year. And again, you can't ignore coronavirus, and we have some example disclosures within the download pack. The other question that we might need to look at here is, well, if you have a company that's been severely impacted by COVID-19 to the point that there's a material uncertainty relating to its ability to continue as a going concern, should we be potentially including a note within the director's report referencing the note in the accounts and just stating that there is a material uncertainty and that there's more detail included within the notes financial statements. So if it's significant enough, in order to give a fair review of the business, well, we possibly should be including a going concern note within our director's report.
And obviously, one of the points there, Mike, is that we're looking here at the auditor's requirement to consider whether the director's report is consistent with the notes to the financial statements. So you've answered the question in relation to principal risks and uncertainties, but now there's a nuance here. If it's an audit, well, it's an absolute prerequisite within an audit context, because the auditor has to form an opinion that both are consistent.
Yeah.
So, Mike, your last area here is principal risks and judgments, key source of estimation uncertainty under section 8 of FRS 102. Accounts are going to have lots of judgments, assumptions, and estimation uncertainty if they're in some of the compromise categories, Mike.
Yeah, and I think we discussed a few of those as we were going along, particularly in the area of valuation. And as things have gone on, I mean, everything has been characterized by uncertainty. Uncertainty as to when businesses will fully reopen, when restrictions will be fully gone, when things will be back to normal. Valuations, what's our estimate as regards to valuations. So judgments and key sources of estimation uncertainty, that'll be to the forefront as well. And again, this is only a requirement under full FRS 102, but that obviously comes with the caveat that if we're doing FRS 102 section 1A and it's required to give a true and fair view, that we should be including those as well. So we've included just a couple of areas where it will be of concern. So going concern, I mean, if we're preparing budgets and we're looking at budgets for the next 12 months, and let's say we're preparing the budgets for a hotel, we don't know when things will be fully operational. We don't know when the consumer sentiment will be back. There's so many assumptions built into a budget that it might be necessary to include within our key sources of estimation uncertainty what judgments have we used when we were preparing the budgets. You know, things like property values, again, you know, we know it's going to negatively affect, or we think it's going to negatively affect property, but we just don't know, you know, will that be 5%? Will it be 10%? Will it be 20%, etc.? So what have we used when we've made that judgment? Impairment as well. So, you know, if that would kind of link in with the whole area of property values. You know, what have we used to arrive at a recoverable amount? How have we assessed the
way I see it, Mike, is pretty much everything that we've talked about today is going to be in these core topics. We're picking the core topics impacted by COVID-19. Obviously, there's the full financial reporting workshop, and I see some questions here about FRS102.com. We have a dedicated UK version of FRS102.com, and when we launch our financial reporting workshop into the UK, which is 4 2-hour sessions over a 2-week period, we will have a fully updated version of FRS102.com dealing with COVID-19. But Mike, these key topics, everything to do with COVID-19 links into an element of judgments and key source of estimation uncertainty.
Yeah, absolutely. Yeah. And, you know, and we've only a couple of them there. I'm sure if you spent a bit longer, you could have a lot more. But yeah, and the important thing is when we use judgments, you know, there's nothing wrong with using judgment. It's kind of, it's part of life for accountants. But, you know, where there are key judgments, where there's a lot of estimation uncertainty, we have to explain how we got to where we got to. That's kind of all from I suppose from a judgments and key sources of estimation uncertainty point of view. I'm not sure if there are any questions there.
No, I think we've dealt with all the questions. We've dealt with all the questions as we went through. So Mike, we're up to the hour, so I just want to thank you for today's session. I love doing sessions with you, Mike, because every time I do a session with you, I learn something new, and I've learned more things new today, and more specifics, and more practicalities. So Mike, thank you very much. And if anybody is looking for Mike, you will be able to contact Mike through our OmniPro website. If you're on our mailing list and you've attended today's session, just hit reply to that, and we'll be able to get in touch with you. You will see more of Mike. Mike is a core part of our technical team, so you'll see more of Mike in the coming year as he goes through various topics and issues that are relevant to him. And I want to thank everybody who's watching us here live. Our live numbers are growing week on week. We have more and more accountants. I want to thank those who are joining us on the Zoom webinar, but also those who are joining us through LinkedIn and Facebook and the various platforms. So to the people who are watching this live, thank you for your time. And for those of you who've signed up, registered, and are accessing the portal to watch the recordings, to thank you as well. So if you know of anybody who would benefit from free CPD, part of our coronavirus webinar series, just send them the links. Where you're watching here today, send them to here today. If they register, if they ask questions, we will come in, we get them registered. So thank you very much. And until I see you again, let's get it done.